Most business owners check their bank balance, see there's money in there, and then they think they're fine. But then the provisional tax hits or a big customer pays 90 days late and suddenly they're not fine. Today I'm going to give you 5 numbers that actually tell you how your business is doing and how to read them. Now, welcome back to The Boring Accountant. This channel is all about taking the boring parts of money, tax, KPIs and cash flow and turning them into simple, practical steps for Kiwis and small business owners in New Zealand. If that sounds useful, consider subscribing so you don't miss out on the next one. Today we're talking about the 5 financial KPIs that every business owner should actually be watching. Number 1, the operating cash flow. This is the big one. More businesses die from cash flow problems than the lack of profit. And those are not the same thing. You can have a record month on paper and still not be able to pay your staff on Friday. Profit is an accounting concept, but cash is real. What you want to track is your net operating cash flow every month, and ideally you are running a rolling 13-week forecast. That is 3 months ahead, updated weekly. For anyone in farming or dairy, the gap between Fonterra payouts or between the season exactly when it matters the most. And for everyone, provisional tax dates could hit you if you are not ready. Know your numbers before the IRD does. Number 2, your gross profit margin. This is revenue minus the cost of goods sold divided by the revenue. What this tells you is how efficiently you turn sales into profit before overheads. It's an early warning system. If your gross margin starts declining or something is wrong with your pricing or your cost of goods sold, you'll see it here in weeks, not months, before it shows up as a problem at the bottom line. Benchmark yourself against your sector. The key word is stable or improving. A shrinking gross margin is a conversation to have now, not just at the end of the year. Number 3, the net profit margin. This is what is actually left after everything, overheads, interest, tax, all of it. This is the truest measure of whether your business is actually profitable, and it is the number to compare against your industry peers. If you're a farmer, keep an eye on how this moves with the commodity prices. A healthy gross margin and a poor net margin usually means that your overheads or your debt costs need attention. Number 4, the current ratio. Current assets divided by current liabilities. This measures whether you can actually pay your bills. Above 1 means technically yes. Below 1 means technically no. A healthy score is 1.5 to 2 times. For any seasonal business, this is a number to watch between your income cycles. When you are funding operations in a quiet period, you want to know that you have a buffer. Number 5, debtor days. This is the accounts receivable divided by your revenue times 365 days. This tells you how many days it takes your customers to pay you, and most business owners have no idea what that number is. For most New Zealand small businesses, if you are consistently above 45 to 60 days, you've got a credit control problem. And it's a slow cash leak. Your invoices are going out, the revenue is on paper, but the cash is not actually coming in. Tighten up your follow-up, tighten up your terms and track this monthly. So 5 numbers: cash flow, gross margin, net margin, current ratio and debtor days. Now, like everything in life, you do not need to track everything, but you do need to track the right things. Pull your last 12 months and calculate each one. The pattern will usually show you exactly where to focus. If you found this helpful, hit like so more people see it, and subscribe to The Boring Accountant for more simple, practical videos on money, tax and investing. If you've got a question like which of these KPIs should I start tracking first, drop it in the comments below. I might just turn it into the next video. Thanks for watching. Till next time.